Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, my guest is Kirk Chisholm. Kirk is the managing principal at Innovative Advisory Group out of Lexington, Massachusetts. He is an expert in inflation, knows a whole lot about monetary policy, and is an expert in self-directed IRAs and 401ks. We didn't get a chance to talk today about self-directed accounts like IRAs and 401ks, which I had planned to, because we spent the whole time talking about inflation and the Federal Reserve and monetary policy. Kirk has a lot of interesting viewpoints on where the markets sit right now relative to history, what kind of paradigm shifts we are entering in the market and the economy right now. He has a different philosophy for how he invests money than we do at my financial planning firm, which is great. He's a sharp guy. We had a great discussion and I think agree on a whole lot of points about what's going on in the economy right now. I hope you enjoy the discussion too.
Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis.
Kirk, welcome to the show, my friend. Thanks for joining me and taking the time to be on today.
Yeah, thanks for inviting me, Grant. This is exciting.
Yeah, so we sit in a similar space. You're the financial planner, financial advisor person like myself, have a somewhat similar firm. Why don't I hand it over to you and let you introduce yourself as opposed to me bastardizing your title and background?
That's fair. I do the same. So, my name is Kirk Chisholm, wealth manager at Innovative Advisory Group. At the firm, I'm both a partner, wealth manager, head of the investment committee, and we do a lot of different things. So I won't. I think you'll probably learn more about me just through this conversation. But we do much like what you do, Grant.
How long have you been at it?
So I've been doing this since December of '99, if you can believe it. If there was ever a worse time to start, maybe it was March of 2009. But December of '99 was the very peak of the internet bubble. And fresh out of college, went to PaineWebber when there was a PaineWebber. Then I got acquired by UBS, and I learned a lot of what not to do. I think the industry changed right at that point where I got in. And a lot of fundamental shifts in the industry, going from commissions to fee-based. I think going from broker-dealer to RAA, there's a lot of big shifts going on in the industry. And so, I got my start there, and pretty much the market went down for 3 years straight. So, you learn pretty quick on the value of risk management. Sorry about that. And you learn the value of risk management, which was pretty much every year, people are losing money with their investments. So I learned pretty quick on how to manage risk. And I think the people who started in the early 90s pretty much had nothing but upside. They just saw bull market all the way, and they didn't really understand that the markets actually could go down. And I think so, even though it was challenging for me, the value I learned was how to manage risk properly and not just, hold my nose and buy and hope it goes up. I had sales managers at the time in 2001, 2002 saying, "Oh, it's down a lot. Just buy right here." These are companies that have ended up going bankrupt, because they didn't think, hey, it's just a bounce. You can buy the dip and it'll go up. And of course, at the time, I was new enough, right? I wasn't blinded by the bull market that everybody saw. So I was able to sidestep that and kind of do my own thing. And I think, we've seen a lot of that now. People, for the last, 13 years have pretty much seen the same thing. So I think there's these, I know we'll talk about this more in the show, but there's a lot of these kind of fundamental shifts that happen. And I happen to be fortunate enough to come in right in the middle of one of them.
Those are, those periods are a hard time to get started, but they are a wonderful opportunity to cut your teeth without having a whole lot at stake. When you just start out, you're not responsible for a whole bunch of money or a whole bunch of clients quite yet, and it's a nice opportunity to kind of take things in while you have a seat without the same amount of responsibility, maybe is one way to put it. I got my start in September of 2007 out of business school. A little bit different setting. I was on a securities lending trading desk. And so one of the few corners of the market that actually benefits when you go down because it's related to short selling activity. When you say you learned how to manage risk there from an early standpoint, how do you think about that now? When you say manage risk, tell us more about that.
Yeah. So in the early 2000s, when I started, like I said, the market pretty much went down for 3 years straight. And at the time, risk management was pretty much diversification, right? You buy a bunch of things, diversification should protect you. And it did. It did an adequate job. Didn't do a great job, right? Because portfolios still lost money, right? The NASDAQ dropped 70% during that time. I was not a tech stock guy. I was not, hot on tech stocks. So that didn't affect me in the same way. We did have bonds, which did well, right? At that time, diversification really worked well. You could diversify stocks, bonds. You could have, nobody was really doing commodities. We did have some gold at the time. But that diversification really helped out. And what I realized after the fact is, even though it worked, it was insufficient. I didn't like the fact that, hey, the market's down 25% and I'm only down 12. Well, it still doesn't feel good. I don't want to be down anything, right? Like to me, that just seemed nonsensical. Like, oh, the market's going down is okay. And so, fast forward to pretty much around the time you started. So in August of 2007, the market dropped 10%. And I started doing a little digging, and some of my clients and friends are in the hedge fund space, and I started learning about what was going on in the housing market, and we went entirely to cash. And the market subsequently went up 10% or whatever it was, 12. It went back to where it started, which clients are screaming, "Why are we missing out on the market and all this?" And I said, just be patient, right? And of course, that's not fun, missing out on upside. We end up missing out on 2008 because we were in cash. Call it luck, call it, skill, whatever you want to call it. It was fortunate, I would call it. But, being in cash helped. It was great for that time period, but that's also insufficient. It's not good enough, because what if the market kept going up 50%, right? I would have missed out on that. And so you kind of went back to the drawing board, and we started looking at the problem differently, because you can't just get in and out, because the question is always, well, when do you get out? And then when do you get back in? Because when you get out, it's always harder to get back in. Well, is now the right time? Is now the right time? So other than being a lucky guesser, it's really hard to pick, the bottom. And I think anyone trying to pick tops and bottoms is either extremely lucky or a fool, because even the best and brightest out there can't do it. So, personally, I don't try to do that. But I do look for paradigm changes in the market. And so after that, we did a lot of research, and we started looking at other ways to manage risk. We frequently use options as a way to manage risk. And I like options because they allow you to define the risk. I know the most I can lose on a position. If the market goes to zero tomorrow, I know the most I can lose, and it's not 100%, right? Because I've defined the risk to a certain number. And I think in these markets, starting in 2008, the markets fundamentally changed. And I think a lot of people didn't realize that. If you've been around for 30 years, you're probably thinking, oh, the markets go up and I just buy and hold and I'll be fine. But diversification stopped working in like the early 2000s for many reasons. But one of the reasons is, the institutions go in and buy all the non-correlated assets and they correlate them. And so what ends up happening is you see these things like 2008, where everything, like if you were in the market in 2008, unless you were in gold, cash, or certain treasuries, you lost 38.5%, give or take a few percentage points. Didn't matter. Diversification didn't help you. And the same thing happened in 2020. It started to happen in 2018, also happened in 2015. There are many instances where the market no longer operates normally. This year happens to be the most normal I've seen it since the early 2000s. But you have these huge sell-offs which don't allow you to manage risk properly, and they don't allow you to benefit from diversification because everything goes down. So that was really the impetus for trying to find a better way. And so we've focused on defining the risk and managing it so we can benefit. So when the market goes up, we're making money, and when the market's going down, we're not losing. That's really the thesis of what we're trying to accomplish.
Sure. The other side of that, of course, is when, especially in volatile times, the cost of those options can be relatively expensive for that defined risk. How do you think think about that in terms of the overall management of the portfolio, and how much of a drag on returns are we talking about when you apply an overlay like that?
It's a great question. So the one thing about options is, they do cost money. Depending on what kind of options you're using, right? If you're selling options, you're making money. It costs someone else money, and you take in that premium. So in a lot of ways, it depends on what you're doing and when. So I think up until about 2018, we were selling options because you could get some really good premiums. You could take, very, very little risk for what was going on. You could get paid well. You could make, 10 or 12% returns pretty easily on some really safe things. And then 2018, the premiums just dried up. And what I realized was it's actually going to be better to buy options at this point because the premiums are so cheap that it makes sense to buy them. Now, ultimately, it depends what you're trying to accomplish. If you're trying to do protective strategies, there is a cost to that. Just like insuring your house, right? If I want to go insure my house, I have to buy fire insurance. Well, that's going to cost me whatever. On $1 million property, let's say it costs me $1,000 a year. That's well worth it. I'll happily pay it because if the house burns down, then you're going to get your money back. But if you don't have it, you're going to lose $1 million. That's not sustainable in a normal family. So I think of the portfolio the same way. And yes, it does cost money, but the way I've kind of looked at it is, if you look back 100 years, you could have lagged the index by 5% a year. It could have cost you 5% a year every single year, and you would have gotten the same performance of the S&P if you didn't lose more than 5% in any given year. So I will happily pay insurance to get similar performance as the S&P without all the downside risk. And that's assuming that you're not buying in cheap, right? That's just getting the same performance, calendar. It's we're talking about quantitative stuff, but really, if you add value there, you could easily enhance that and do a lot better. Like, for example, if you were protected going in 2020, like we were, you could easily sell options at the bottom. Not saying we did that, but in hindsight, that would have been a good play. You would have made 30% annualized returns if you did that. That's an opportunity that you normally can't do if you lost a lot of money going into that period. So there are a lot
puts,
of,
you mean?
Yeah, by selling puts.
Selling puts,
correct. Yeah. So you can find these opportunities, but it's about thinking about the equation differently than buy and hold, or I call it buy and hope. It's looking at the situation, saying what is the best possible outcome given the tools that I have available to me.
Sure. So what are you seeing right now? And what is the strategy du jour for your shop? Are you buying puts, selling calls, a combination of the two? How are you thinking about it now?
So last year was a little bit more volatility, and we were doing some option selling. This year has actually been as everyone knows, is a crazy year. We've taken a very different strategy akin to what we were doing in like 2007, 2008. So I'm going to talk a little bit about a paradigm shift that we started to see last year and really kind of hit us in Q1 that this is happening. So people for a long time have been talking about a lot of crazy ideas, right? Like they're printing a lot of money. We're going to have hyperinflation. I'm sure you've seen the ads and people selling fear. I don't sell fear. I think that's not really the right way to do it, but our industry does. So I look at things like that and say, okay, are they academically correct? Yes. Is it happening? No. Well, we've had 40 years. So think of it this way. Starting in 1981 until last year, we had 40 years of a bull market, which I wouldn't say is unparalleled, but it was a huge bull market that if you were bullish for 40 years, you would have made a lot of money. There was an enormous amount of wealth creation and abundance created with our entire country and in large part in the world, because interest rates went from a high of between 15 and 20%, depending on what you were in, down to a low of 0. And as you know, as interest rates start high and go lower, you make money, right? You don't make money, you lose money when they do the reverse. So we started at, let's call it 15% interest rates, and it went to 0. Do you know what the best performing asset was in the securities market during that period?
To say gold or bonds, but I know that's not true. I don't.
30 years, 0 coupon bonds were the best performing asset, better than equities, better than anything, by a huge margin, not like, by 1% a year. I'm talking like almost double the return of equities. If you were getting 15% return, it's not hard to compete with equities that are getting between 7 and 10%, depending on the year, right? So the 0 coupon bonds, were buying a bond with a high yield for 30 years, did really well. So think of it, let's use an illustration to kind of illustrate the concept, right? So we had that abundance created. So back in 1981, if you wanted to buy a house, right, you could either save up all the money and pay in cash, or you get a mortgage. But the mortgages were as high as 18.5%. I think 18.65, I think was the highest. 18.5%. Well, I don't want to pay 18.5%. That's highway robbery. That's, if I had terrible credit, I'd pay less than that, right? So 18.5% is a lot, and the cash flow is really hard. But what that means is you can afford less house. And it's not just me, it's everybody, right? Everybody can afford less, which means that the house price is going to be very low. Because if I am going to get a mortgage, it means that I can't afford that big of a mortgage based on my cash flow. Now, take that 18% down to 2%, which is what we had 6 months ago, if you believe it, 2% 30-year mortgage. A $700,000 house at 2% and a 30-year mortgage is $2,500 a month. That's your payment, right, on that house. Now let's say mortgage rates go from 2% up to 7.5 or 7.75, I think it is. Now all of a sudden that doubles from $2,500 to $5,000 a month. That means you can afford half the house, because most people, as you know, are buying as much as they can in a house, and they're stretching themselves. So they're paying $2,500. That's all they can afford. Well, that means they can't buy a $700,000 house. They can buy a $350,000 house, which, if you follow where I'm going, this means that real estate logically would drop by 50%. Now, I'm not saying that's going to happen. I'm saying directionally, that's where it's going, right? So if you look at 18%, which I don't know how many doubles that is, but you'd maybe be able to afford like $150,000 house at 18%, right? With the same numbers. So that's where it started in 1981, is you could afford a very low mortgage, right? And then as interest rates dropped, you could afford more and more, which allowed people to buy bigger and bigger houses and allow them to buy more or more expensive property, right? So real estate, that's how real estate operates, right? It operates on cash flow. So the lower the rate, the more you can afford. Now take that example and overlay that into the US economy. It operates the same way. Businesses operate on debt, right? They borrow money to improve their cash flow, to grow, all the things that businesses need debt for, right? Now, if you have an 18% rate that you're borrowing at, you're going to take on a lot less debt. If you have 0%, which is close to what it was for a lot of companies, then you can afford as much debt as you want, right? If you're going to loan me money at 0%, I will take as much as you'll give me, right? Because it's 0%. It makes a lot of economic sense. And that's what was happening, is people had private equity, venture capital, up the price of stocks, of businesses, because they're borrowing it close to 0. Why wouldn't you borrow money? So it allowed the economy to grow. Think of a balloon that's starting small with no debt, and you add debt and it just keeps blowing up and blowing up. Well, at some point, it can't go any further and it starts to deflate. So for the last 40 years, the balloon has inflated to the maximum it was, which was the end of last year. And then we started to hit inflation. And inflation basically shrunk the balloon because inflation is typically closely aligned with interest rates. So as interest rates go up, it means that the balloon has to decline and shrink, which means that all of the wealth creation that is created over that period is now going to start to shrink. So hopefully that's clear. I'm trying to paint a picture to help people follow along, because this is a enormous paradigm shift that's happening. And most people right now don't even know that it's happening. And they will know in about a year or two once things get a little bit more rocky. But inflation is really bad for the economy, and we haven't had it for a long time. I wouldn't say 40 years, but inflation has declined significantly over that period to the point where it was close to zero in recent years. Now it's up to 8.6%. Now, I would argue that it's higher. My gas prices have doubled in the last 9 months. My food prices have doubled. I don't think 8.6 really tells the picture, but let's just assume that's an accurate number. That means interest rates are going to have to pair with that at some point to close to 8.6% or higher if they really want to stamp out inflation, which means that the economy will most likely go into recession. And that's assuming that inflation gets stamped out quickly. I've done the math. I've talked to a lot of my clients who work in the supply chain. The supply chain is the cause of inflation right now. It's the primary cause. It's not the only cause. There are a lot of contributing factors, but it is the main factor contributing to inflation. And until that's fixed, which will probably be 3 to 5 years from now, then we're still going to have this inflation problem. And then at that point, we'll see, because government tends to make bad decisions, as they always have historically, because they're trying to make people feel good, and they tend to make it worse. I remember in the 70s was a tough period. If anyone remembers that period, it was tough. It was tough times, like the government made a lot of bad decisions, like price or rent control. Those went horribly wrong. And I'll bet that they try something like that again, because they're trying to make people happy. And it may prolong the inflationary period, but the simplest way to put it is I would say that we're heading into a period much like the 70s. So our risk management is, we can get into that in a minute, but our risk management is really quite simple in that we're just sitting on the sidelines waiting for the storm to pass, because I don't think this is over. And I don't think the market has digested the gravity of where we are. I think we're very accustomed to the old paradigm, and most people think you can just buy the dip and it'll get better. And as long as interest rates are going up in the degree that I think they are, the markets are not a safe place for money.
That's interesting perspective, and I think I concur with most of what you shared with us right there. But I would push back a little bit on the idea that when interest rates go down, you make money, and when interest rates go up, you lose money. It's a little more complex than that. And if we go back, yes, the 70s were tough. It's before my time, but look at the period between World War II and from there up until 1981. Yes, there were a couple tough periods in there, but the economy expanded in a big way over that time period. We had all the gold, we had all the power after winning World War II, right? The US dollar was and still is the world's reserve currency, but there was a lot of innovation and just economic expansion here nationally that even in a generally rising rate environment between mid-40s and 1981, mostly in the early 70s, 1981, after we left the gold standard, there was still a huge late 60s. Thank you.
Yeah.
There's still a huge economic expansion that created a whole lot of wealth. Real estate and other assets gained a lot of value over that time period too, right? I don't think it's quite as simple as saying that we've inflated the balloon as much as we can. Now prices are starting to go up. Primarily, I agree, it's primarily supply chain oriented, but not exclusively.
Right.
We just printed $6 trillion. That had something to do with it too. But now that rates are on the way up, we still have the most diverse economy in the world, and the US dollar is the world's reserve currency. How do those two things play into it?
Great questions. So I'll try to hit on as many as I can remember. So going back in history, if you look at the late 60s, we're very much in a similar place that we are now, where interest rates were lower, they started to climb. Inflation was lower and started to climb. And a lot of that, you mentioned the gold standard and gold. I will tell you that, while I think we're going to be very similar in the future is going to be very similar to the 70s, it's not going to be the same. Because at the time, like a lot of people say, oh, gold's going to go through the roof. Because look at what happened in the 70s. Yeah, you know why it went through the roof? It was because it was undervalued for decades. They weren't allowed to trade it. And all of a sudden, now you allowed it to trade. And it went through the roof because it was like holding a beach ball underwater. It just skyrockets because it's been held underwater.
You weren't allowed to own more than like $20 worth or something like that, right? Until
you were only allowed to own rare coins. Like you weren't allowed to own any gold outside of that, unless in terms of currency. I think you could hold. There was some issue with Krugerrands, but the point was it wasn't allowed, and then it was allowed. It went from like whatever, it was $50 up to $800. So people say, yeah, I have to have gold. It's not the same time period. Like the reason for that is different. So just like what you said, is inflation the only factor? Absolutely not. It is the major driving factor, but there are other factors too. And these factors have been, and here's how I look at it, right? So we can all come up with reasons for why things happen. Ultimately, we don't really know, right? The economy is a complex creature, as you said. You don't truly know. But here's what I do know. There are a lot of things that make sense, and there are things that don't make sense. So when I see something and somebody says, this is the reason, and it doesn't make sense, it gives me pause. Let me give you one. We printed, whatever, $8 trillion. Oh, that's going to cause hyperinflation. But why is inflation at 2% or lower? Oh, they're doctoring up the numbers. I don't know if I buy that. Like that, maybe to some degree, but not, you don't double the money supply and it goes up. Even if it was from 2% to 10%, you doubled the money supply. Technically, it should be 100%, right? But so to me, that never made sense and it never lined up. And I figured out why, at least theoretically, I could kind of share it. But basically, inflation is the driving factor. It is the primary factor in all of this. So another contributing factor, of course, you can look at Ukraine war as a contributing factor. We had inflation prior to that, so it's not really the factor. So if you kind of ignore the news on that point, does it contribute? Absolutely. But it's only contributing. It's not the factor. So you can also look at globalization. We had globalization for the last 20 years, which helped export our inflation internationally. It allowed us to take our inflation and send it over to China, right? And it allowed us to buy stuff way cheaper than we otherwise because they're using people that get paid $5 a month. Yeah, they can, all the stuff we buy. I mean, I remember hearing this, I was reading a book and they were talking about this, like in the 70s, it was like, and I hate to use this anecdote, but people had one plunger in the house, right? For the whole house, you had one plunger. Now you could have one in every. Like they're just, they're falling off trees. They're easy and cheap to make, right? You think of all the computers that are made that have increased their computing power every 18 months, yet they still cost the same as 20 years ago. I remember like the type of computer I got was like, if you look on like there's high end, there's low end. Like I was usually a step down from high end because that was the best value. It would last the longest. You weren't overpaying. That cost was $2,000 a computer 20 years ago. It is still $2,000 for that same type of computer, right? And yet the technology has expanded drastically. The capability of it is, exponentially better than it was 20 years ago. So we've had deflation in things like that, right? We've exported our inflation to other countries. So that has allowed us a lot of things. That is the globalization concept, right? We're exporting a lot of our manufacturing overseas. Now we're seeing it's actually become a problem. So starting with, this was actually a problem before Trump got elected, but he put a pin in it as here's what we're going to do. We're going to reverse globalization, right? And so what happened was all of the globalization that was happening helped us expand. It wasn't just inflation, but it helped us export the inflation. So it kept the inflation low, which was an ideal environment for us to grow and build wealth. But now that started to reverse, which means that we're resourcing some of that international manufacturing, what have you, back to the US. or to other countries which are more expensive. So as the globalization reverses, and some of it's for good reason, you could argue the validity of it, but it's happening regardless. And that's causing the balloon to shrink, right? That's causing a inflationary pressure because you're allowing the inflation to come back. And now, I mean, think of it, right? COVID shut everything down. And now we're having problems with China, right? And so they're resourcing the manufacturing back here because they can't rely on China exclusively because of, the geopolitics going on. So now it costs more. Willing to pay twice as much for a car? I don't know. I'm not, right? Are you willing to pay twice as much for all your goods and services? No, I don't want to, but if I can't get it, it's better to get it than not get it. So the inflation is a complex topic, as you said. It's primarily supply chain, but there's also the globalization that's reversing. We have demographics which are happening here in the US as well as they are internationally, which also affect that. But even the whole topic of inflation is complex. So before I get to the money supply thing, which is an important topic, I want to touch on this one point. Because I think inflation is, people look at it simplistically. They say, oh, inflation is the CPI. Here's what it is. But it's really not, okay? Inflation is a very complex hodgepodge of different prices that we all pay.
And if I can I interrupt just for a moment?
Yeah, go ahead.
So for our listeners out there that don't pay attention to any of the technical stuff, when we say inflation, a lot of people synonymize that with CPI, which stands for Consumer Price Index. And so the Department of Labor does this?
I believe so.
Operates the I think it's the Department of Labor. The federal government goes out and prices a consistent basket of goods and services that everyday people typically purchase in a given month, and then tracks the price of that over time. That basket of goods and services for Kirk is going to look a little different than mine. Coincidentally, the CPI that we see excludes what? Energy and food? Are those the two?
Yeah, pretty much.
So clearly, we all pay for energy and food, and the inflation that we're seeing at the gas pump and in other places may not be reflected in that measure. Sorry to interrupt, but when you say CPI, that's the measure, the most common measure that you see in the news with regard to inflation.
Yeah, and to clarify, just the point, the U.S. Bureau of Labor Statistics is the one that publishes this.
Thank you.
So getting back to the point, and I appreciate your clarity here. Inflation and the CPI is a complex thing, right? I'm trying to simplify it just for everyone, because if you really get into the weeds, you'll get lost. But here's the way to look at it. People look at it as a number and say, oh, that must be the inflation number. But inflation is just a number, right? I look at it as it's an adjective, right? What's inflating, right? Inflation of what, right? People look at inflation and say, oh, it's because they printed money, or, it's because of this, because of that. It's a descriptor, right? It's wage inflation, asset price inflation, commodity inflation, right? Consumer goods, there's, and then there's deflation, right? That's the other side of it. Deflation is the reverse of inflation. Inflation is going up, deflation is going negative. But basically, it's composed of a bunch of different things, right? So when the CPI first went up to a high number, I forget, it was 6 or 7% last year, people blamed it on used car prices. Oh, used car prices are up 40%. Oh, that's why we had inflation. Well, it was more than that. But if you look at COVID, right? So look at COVID, for example. And I have some, let me bring up some of my numbers while we're talking. So COVID, we had inflation for certain goods and services went through the roof. So things like bicycles, was high inflation for bicycles. You couldn't find them. I actually sold 2 of them during that time because people wanted them and I wasn't using them anymore. Medical care, newspapers, streaming services, cleaning products, food at home, books, things like that were inflationary, like highly inflationary. Even though everything went down, you'd say, well, goods and services went down, but those were inflationary during that period. But then there were things that were deflationary, like airfare, hotels, city transport, shoes, clothes. So that was at the same time, you had things that were both going up and going down based on the supply and demand, right? Who wanted to stay in a hotel when you had COVID? Well, almost nobody. So the price went really low. And so you could look at that for goods and services. You could, as an aggregate, the Bureau of Labor Statistics comes up with a number and they say, oh, it's this number. Now, you mentioned food and energy prices are excluded. Primarily, they're excluded because they're volatile and they say, well, they come up with some excuse. We don't want to include it. But if you really think about it, what do you really need? I need food and I need transportation and I need electricity. And in my, assuming you have a house, right? So having those things are essentials. That's what everybody needs. So the CPI is kind of irrelevant. I don't care about used car prices. I'm not trying to buy a car. I don't care about the cost of college if I'm not sending my kid to college, right? So there are things that don't apply to everybody. But when you have the food and energy prices double in the last 9 months, I would argue that affects everybody significantly. So the whole concept of inflation is complex, and I'm trying to simplify it here for the sake of our conversation. But I would argue that we have a lot of inflation now for the supply chain problems. And everybody I've talked to that I have clients that work here in the supply chain, they all say the same thing. It's like we had a very fragile supply chain. It was extremely efficient. They reduced the costs almost as much as they could. It was, really, really efficient, but it was fragile, right? If you go back to Nassim Taleb's Anti-Fragile book, it was a fragile setup, which you throw a little sand in the gears and the whole thing stopped. And now they're trying to get it restarted, but they can't because it's not resilient. It's not created to be resilient, which is what they're trying to do now through the reverse globalization, which is make a more resilient supply chain. So be more regionalization. I don't want to get too much in the weeds, but the point is it's going to be more costly to have a resilient supply chain. So the costs are going to go up. Now, wages have started to go up in the last year or two because people couldn't find labor. So they decide, hey, I got to pay somebody more. But wages have stagnated for the last 20 years up until recently. So even though we've had inflation that has been at points higher and lower, the wages have stagnated, right? So we've had wage stagnation, I would call it, even though it's not really a word. Some people are talking about stagflation, which, I won't get into that topic, but basically stagflation means we have high inflation and we have economic stagnation, which means at best it's treading water. And most likely it means it's also going down. So I would predict probably next year we'll have stagflation. We won't have it this year, but next year we'll probably start to have it. So you have these different levers that are moving up and down. But at the end of the day, what you're looking at is what are the prices doing and what can people afford? Now, if I have a family of 4 and I'm trying to feed my family and it costs me $500 a month, and now it's going to cost me $1,000 a month to feed my family, the extra $500 has to come from somewhere. Well, it's not gas prices, because I still got to fill the tank. And by the way, it also costs more there. Maybe I have fewer vacations. Maybe I buy fewer clothes. Maybe I, buy fewer stuff. So that money's coming out of the economy, right? It's coming from the necessities and coming out of the discretionary things. So people are spending less, which means that that the producers. So let's say I'm going on fewer vacations. I don't stay at a hotel. Well, maybe they have to lay somebody off because I didn't stay there. Now that person has less money. They spend less money. So it gets into this spiral of where the economy gets into somewhat of a stagnation, we'll call it. And that's going to cause a problem when we have high inflation. And so we have this situation which is happening, which I want to explain, then I'll come back to the monetary stuff. We have this situation that's happening. We have high inflation, which if you look at the end result, if we let this stay, if we let the high inflation stay where it is, that 8.6 turns into 15, 20, 30, 40. You can't let inflation stay, or it will feed on itself and will go higher. Because if, let's just say it's at, my gas prices have doubled and now I realize, well, they're going to double again. I'll reserve, this is a bad example. Let's use food. If my food's going to double again in 6 months, I'm going to buy as much food as I can now before it doubles, which causes people to want to buy more food, which pushes the price up. So inflation feeds on itself. So they can't let inflation go, or it ultimately will lead to hyperinflation, which is what happened in Weimar Germany, in Venezuela, Zimbabwe. It basically means that your currency is worthless and the government falls apart because you can't pay for your currency is worthless. It is the worst possible scenario and everybody knows it, so it won't happen. Let's just put that on the table. So don't worry about it, because you'd have to let that happen. And the government is, as much as I don't think very highly of them, they're not that dumb. So the other outcome is that they decide to fight inflation, which it appears is that they're doing right now.
Kirk, you were explaining how inflation compounds on itself there before we got disconnected. I have to push back on that just a little bit. And you were moving toward comparing our current situation to Weimar Germany and all that. Those, and I hope you agree with me, are completely different situations from what we're in now. After World War I, Germany owed a whole bunch of money to other countries in their currencies. We're talking about US dollars, and we control the printing press, totally apples and oranges. And there is an innate self-correcting mechanism there, right? And in your example, if the price of my groceries is going to double every week, and I know that, then I'm going to buy twice as many groceries and stock the fridge so that I can avoid that price increase. Absolutely true. But to a point, the producers are going to get involved when they can. Clearly, we have supply chain constraints in there too. But if prices are doubling every week, the grocery store is going to say, holy smokes, I need to get in on this. And they're going to try to supply more to meet those higher demand for higher prices too. So there is an element of self-correction in there as well. But I agree with you that it does kind of continue, if not unabated.
Yeah, and just to reiterate your point, that's going to happen. I'm saying that's the end result of the direction we're going. Is if we don't make any corrective measures, that's where it ends up going. I think it's highly unlikely that happens. It's like saying that the U.S. government's going to default on its debt. It's highly unlikely that's going to happen because they don't have to. They just print more money. Like there's no possible way the U.S. government could default on its debt unless it chooses to. Other countries, like you said, it being a reserve currency, other countries don't have that luxury. We do. So in that way, we're never going to default on our debt. But hyperinflation is certainly possible. It's just improbable, because the things you would have to do to make that happen would basically means that a lot of other things have gone wrong. Hyperinflation happens effectively when people lose confidence in the currency. And what they're trying to do is they're trying to get rid of it as soon as possible. Oh, you get paid? Great. Let me get rid of it and go buy some goods. So the quicker they get rid of it, the faster inflation picks up. And that's the big piece. I think a lot of people don't understand the hyperinflation. They just think, oh, we're printing a lot of money, it's going to lead to hyperinflation. It's not. And I'll talk about that at the end of this little piece. So the other side of it, so you have hyperinflation on one side. The other side is we have a very severe recession or depression. If you take it the other extreme, if you push interest rates up to 20%, you're going to see a depression, because it affects everything. Not only that, but our whole economy has been based around low interest rates for over 20 years, which means that nobody's accustomed to that. It's just, you're not accustomed to it. So how are you going to run your business? If you have a lot of debt, you're paying 1% and then you have to roll it over and now you're paying 15%. How am I going to do that, right? Businesses fail. It causes that shrinkage, which basically means that people have to delever and people have to pay down their debt and all those things. But that paying down debt shrinks the economy. So all of that pushes for a smaller amount of money or wealth in the system. So the other side of it is the direction we're heading. I'm not saying it's going to get to the extreme end of it. I'm saying that is the direction we're heading, which means that in some degree in here on this side of it, it's going to be a recession of some sorts. And they want that because, look, I know Powell came out this week and said, oh, we're not trying to push us into recession. They've clearly stated that, which if you know how governments work, anytime they come out and state that something is not true, it means that it is true, that they had to actually come up with and say something about it. So anytime that they say it's not true, it's usually the time you have to be scared. So they are trying to push into a recession because what they're trying to do is slow down demand. They're trying to slow down people purchasing goods and services, which will allow the supply side to catch up. So it's the most logical thing they could do. It may not be the right thing to do, but it's the most logical thing they can do. And there will be some pain. Like, it's not going to be easy. Right now, we have 1.5% interest rates, and the Fed funds rate was at 1.5 to 175, and inflation's at 8.6. That's a big margin. Usually, the margin is like 1%, maybe 2%. We're at like 7%. That's a lot. Okay, so the concern is that it's going to take them a long time to get that 7% margin closed. The quicker they do it, and I forget which year it was, but I found out that that back in, I think it was the 70s or early 80s, did you know that they raised interest rates a full 10% in 1 year? Yeah. I just read that the other day. I was shocked. A full 10% in 1 year. And we think 25 basis. Yeah, I mean, that was what happened. I didn't realize it was that much. I thought it was like, 5%. It was 10. And that's a lot. So I think at some point, I don't know if we have that kind of leadership in our government, but if we do, then that would happen. It would probably break the back of inflation. The only problem with that is it doesn't solve the problem. It causes a recession, which slows it down, but we still have a supply chain problem, which will take 3 to 5 years to get fixed. So I think to some degree, we'll have inflation for the next few years until they'd have to really shrink the economy pretty hard in order to actually get that balance. Now, I do want to address one point before we address the other thing you said. So the money supply, a lot of people think that printing money equals inflation. And I think from a textbook example and an academic sense, yes, technically that is true, is that printing money should equal inflation. However, it doesn't necessarily, because there's another piece of that equation that nobody ever talks about, and that's the velocity of money. So you can print, and I'll give you this example to help illustrate it. Let's say I'm the Federal Reserve, and I decide, let's say there's, $1 trillion of money in the system. And I decide I'm going to not print up $1 trillion. I'm going to print up $100 quadrillion. I'm going to go crazy and print up all this money. But then I take that money and I stick it in a bank vault and I lock the door. Do we have inflation? No, because it's like that money doesn't exist. You can print it, but no one's using it. So it's pretty much not being used, right? So effectively, that has caused the velocity of money to drop significantly because no one is spending it. It's basically like it was before. So if you look at the amount of money printing, a lot of these newsletters and people selling fear will say, oh, look at all the money printed. It's crazy. But they never talk about the velocity of money, which has gone through the floor starting in late 80s. Late 90s. It peaked out. I think it was like 97. It peaked out. And it's gone from like 2.2 down to like 1.1. So it's dropped 50%, especially through COVID. It dropped significantly. The point is when you kind of put those two together, you don't have high inflation. And I'll explain why. Because the Federal Reserve is not looking to create high inflation. They're looking to create a situation, an environment with low, consistent inflation. So anytime we had a recession in the last 20 years, the Federal Reserve printed up a lot of money. They didn't do it to create inflation. They did it to fill the hole. So when the economy drops, wealth is destroyed, right? People lose a lot of money temporarily, right? So the Federal Reserve, just like they did in COVID, they printed a lot of money. They gave out handouts to people, all the things that they did, and that allowed us to fill that hole. It wasn't trying to cause inflation, it was trying to fill the hole. And they did that, right? So you kind of have this smooth ride of this, this like low to mid inflation, and then the supply chain problems hit, and then all of a sudden it started to go up, right? And that was outside of their control. But the money supply is not something I worry about with the US government because they have full control. They don't have control over the velocity of money, but they have control over the amount that's printed. And the more money they print, the lower the velocity goes based on how our economy is structured. Now, what you want to,
they do have some control over the velocity, though, because they can also set the reserve requirements, right?
They can.
If you print $1 trillion and then that just sits in your bank account and mine, they can't control how much of that we're spending, but they can control how much the banks are required to hang on to and how much of the extra that they can lend out, right?
Correct. They can do that. But I think it's some of the problems that have happened in the last 13 years, with the banking crisis is banks have been, I don't want to say prohibited from lending, but they've been, disincentivized from lending. I mean, try to go right now as a business owner, I can't go get a mortgage. If I'm a W-2 employee, I can, But if I'm a business owner, let's say I wanted to buy a house for $1 million and I had 10 million cash in the bank, they would not take my mortgage because I am not a W-2 employee. I've talked to many people who've had the same situation. They're like, I have to pay all cash because they won't give me a mortgage. Or businesses. Businesses is really hard for small business to get loans. It's because the banking system has tightened up so much that they're not lending. And there are two reasons. There are two reasons that money is created in our economy.
Is that recent? I mean, we got a mortgage, a refinance mortgage not too long ago. I'm a business owner, and they took a look at the last 2 years worth of income history and used that as a basis for underwriting. And then on the business side, you still have all the SBA programs that are very attractive options for buying commercial real estate and other things. And what am I missing there? Has the environment changed in the last 9 months?
So I'm being a little hyperbolic. It's not a binary thing, yes or no. It's a lot harder to get them. So I know when I tried to, let me give you an example. I tried to refinance my condo 5 years ago. Refinance, no cash out. It took me 9 months for the lender that I end up going with. It took me another 6 months prior to that because I was just trying to find a lender that would actually do it. It took me 9 months to go through all the rigmarole, to give them 10 million different documents that they already had and asking again. It was a nightmare. And I'm not saying it should be ninja loans, but there's a balance in there that's not there. And I've talked to enough people that are wealthy that just can't get mortgages because they're not basing it on things that they should. Banks have a different standard of lending. So yes, you can get them, but it's harder. It's a lot harder, which means that they're not lending out as easily. Businesses, God, I have so many business owner clients. It's taken me a whole year to get them, a loan for some of them, SBA loan. It's just banks are unwilling to take the risk that they used to take prior to the craziness with the real estate bubble. I'm not talking about that. I mean, even before that,
sure.
They're not willing to take the risk. So there's two reasons that there's two ways that money's created. One is through the Fed printing it, right? And the other one is lending. Banks create money. But the banks, if they're not lending, it means they're not creating the money. And they've been for over a decade, they've been happy to sit on their cash and not lend it out because it's safer and they can make the margins they need to make. So the point is if they're not lending, which multiplies the money supply, it means that the velocity of money is shrinking. So you have these dynamics in play. I'm not judging. I'm just saying this is the reality of what's happened. That if this continues to happen, it creates problems. And right now, what you should be concerned with is if velocity money starts to take off. That's when hyperinflation starts to happen. And that's when you have to really be concerned. But until that happens, it's not really a problem. So that's the money supply problem that I think a lot of people misunderstand and, hopefully kind of put it in a way that's a little bit more bite-sized.
Yeah, that's well put, Kirk. And I talk to people about that all the time. We just printed $6 trillion. Obviously, there's going to be a whole bunch of inflation. It is not that simple. We like to, our feeble human brains like to boil this stuff down into if this, then that. There are so many factors involved in this stuff that it is very hard to make any kind of blatant statement like that. And it's often flatly untrue.
Yeah, and when you have high inflation, it actually makes things a lot harder to predict. If you look back in the 70s, this is one of the symptoms that happened back then. If you think back to like the early 2000s or even the 90s, you could plan, right? You could plan 2, 5, 10 years ahead, and big companies did that routinely. But when you get in a situation like this, it makes it a lot harder to plan. You have to be very agile and adaptable, and you have to be really good at short-term planning because you don't know what's going to happen, right? Like I'm telling you how I see the game mapped out, and I see, if-then statements. If this happens, then I do this. If this happens, I do that. Like to me, it's very clear the direction that we're going. But for most people, they're listening to the government, they're listening to the Fed, they're listening to the news, and no one is giving them the truth. The Fed has no incentive to give people the truth because they're trying to play their own game, right? They're trying to do what they have to do, and some of that is PR. The news doesn't know because most of them aren't smart enough. Some of them are, but most aren't. And people just don't understand it. And the big problem is it's been 40 years. So if something hasn't happened in 40 years, who around here has experienced that? I didn't, right? I was born in the 70s, but I didn't economically experience it. You didn't. You'd have to be what? 60, 70 years old in order to have experienced it economically, which is a bit of a problem, right? Because if you didn't experience it, you don't know what to expect. Once you've experienced it, you won't forget it, right? Like I remember 2008 pretty vividly. I'm not going to forget that, right? People who were around for World War II are never going to forget that. They experienced it, but I didn't experience that. So I don't have the same reference points. And I think that's part of the reason that history repeats itself, is because when another generation, passes on the torch, they're no longer around to advise younger people. Like, think of it this way: the stock market from 2009 until last year, what was that? My math's a little off. You have 12 years. 12 years that pretty much the markets just went straight up. And you had some speed bumps, but 2020 was a speed bump. I wouldn't call that as risk. I would call that as volatility, right? How do you end up the year up 10% when market drops 30? I'll never know. But if you look at that, like, if you didn't experience 2008, you don't know what a bear market looks like. You don't know what a down period looks like. It looks good on a chart, but you don't know. You don't know how it feels when the market feels heavy. Like, I've been through a few of these. Like, I can tell you, I know when the market feels heavy. It's a feeling. It's not an analytical quantitative thing. It's like, the market's not it's not going up in the way that it typically would. Like, it's just, there's no way to describe it from a numbers perspective. But the point is what I think doesn't matter. What the market as a whole thinks does matter. And right now, the market thinks that this is just a speed bump, and they're not counting in what's actually coming in the future. They're not. In some ways they are, but for the most part, a market down 20%, 30% with what's coming is not accounting for all of the stuff that's coming in the future, which I don't think people disagree with that. They just disagree with how bad it's going to get because they didn't experience it. So I think that's the biggest problem. And I think we will have some sort of an aha moment that might cause I don't want to call it a crash, but cause people to come to their senses. And, I hope that doesn't happen, but I think it's inevitable. Like, how do you square the circle when you have all the data that's lining up the way it is and people still want the valuations that they have? I mean, I'll give you an example. In May, I think it was May, I don't know, it was April or May, the Buffett indicator that he looks at for market valuations, where you basically take the total market valuation divided by the GDP. In normal times, it'll fluctuate between 80 and 120%, 80 being cheap, 120 being expensive. I think it was like April or May. Or maybe it was late last year. Either way, it hit 220%. That is not a market that is accurately valuing what I've been talking about today, or even a normal time. That's not accurately valuing anything. That's twice as expensive as it should be on an expensive time on a historical basis. So I look at this and say the numbers are so far skewed that you can't, this gets back to your earlier question of risk management. I don't see how you can manage risk in a time like this other than stepping aside, unless you're trying to short the market. Like, I don't see any alpha in trying to pick things that are going up, because 2008, nothing went up except for cash, gold, and, some short-term treasuries. And I don't really want to bet on that because interest rates are going up. So bonds are out, maybe gold, I don't know, but cash is the most viable option. And I hate to do it, but at some point, sitting on the sidelines and waiting out the storm is not a bad approach, even though it's not my preferred approach, but it's probably the most cost-effective way to go.
Sure. And our philosophies, the way that we work with clients and manage portfolios are a little bit different. I am someone who tries to remove myself from all the irrational human behavior, because I know it is irrational and impossible to predict. And you made the exact right point. At the end of the day, it doesn't matter what I think or what you think. It matters what the aggregate of the market thinks, and that's out of every individual human being's control. And I'm someone who prefers to continue to be consistent throughout all of it. I wasn't around in the 70s. I have been through a couple of these crashes. But at the end of the day, the U.S. is the strongest and most diverse economy in the world. Maybe that will not be the case for the rest of our lifetimes, but there are a lot of good arguments for staying the course as well. And you mentioned the Buffett indicator that skyrocketed up to 220. It has absolutely been high,
But that number was during the few quarters when GDP fell off the map in the middle of COVID too, and quickly spiked back over the subsequent 3 or 4. I'm not saying that it's not high, but it's that 220 was a little bit of an aberration. And I also have to defend the Federal Reserve a little bit too. Remember, they exist for two reasons, right? And I'm not someone who thinks that they're 100% forthcoming about everything that's going on in there. They're playing a PR game as well, but they exist for two reasons: price stability and full employment. That's their dual mandate, right? And when we printed all this money, just as to your point earlier, Kirk, it's not so simple as we print $6 or $8 trillion and it immediately results in inflation, right? They printed the money because there was no inflation at the time. It promoted full employment at a time that was very hard. Restaurants, everything was closing down temporarily. And now inflation is a thing. So is it supply chain oriented that will resolve itself sometime soon, 3 to 5 years, hopefully sooner than that? Or is it the other side of the equation where we do need to raise interest rates aggressively to bat it out and get in front of it? That's a dangerous line to walk. There's a lot of people out there who really have a distaste for the Federal Reserve and think that they're evildoers that need to let the market adjust for itself. But when you have price stability, remember what number two is. They're there to promote full employment and economic stability. So you make some great points. Our philosophies are a little bit different in how we do it, but I agree with a lot of your point of view.
Yeah, I have to say, I mean, the Federal Reserve point, I really don't like that people are so binary in their thinking. They're either good or they're bad, right? Like, I think, I've come to a more nuanced opinion. I think there's some definite problems with the Federal Reserve, right? In many ways. And I think, you could take it down to the core basics and say, well, we don't need a Federal Reserve. Well, okay, we have one. So let's not go down the road of why we shouldn't have one, because we have one. So if you're going to say we shouldn't have one, then what's the path from where we are to where we need to be? And the path would be, it's unspeakable. Like I couldn't think of a scenario where that would even be possible, right? So I look at it and say, just like you said, like they're playing a PR game. That's their best weapon. And if you really want to get into the nitty gritty, what they're actually doing is very nuanced and brilliant. And I give them credit where credit's due. I think they've made lots of mistakes, but what they're doing is we have inflation at 8.6. We have interest rates up till recently at 1%, right? And what they're trying to do is squeeze that gap. So they're going to talk down inflation. I would argue inflation's probably like 15% plus, but so they're trying to talk down inflation. It's not that bad. And they're trying to talk up how hard they're going to raise interest rates. So they're trying to squeeze the gap because the market prices in future expectations. So what they're doing is they're giving you future expectations of this slimmer margin, so the market prices that in. So that's actually what they're doing. They're trying not to raise rates any more than they have to, because it would be a terrible outcome if they had 10% rates. They know it. It's the better solution of the two that I gave earlier, but it's not a great solution. So they know that, and if they can squeeze it, they just gave 75, and one of the Fed governors today, I forget who, said, all right, we're going to do another 75 in July. Well, I think that's the right move. But whether they do or not, they're telling the market that, so the market is discounting it. Look, the market's up today. I think their strategy is brilliant without having to do the hard work. Because if they have to do the hard work every time, then eventually you stop trusting, right? You
Exactly.
stop believing them because it's the boy who cried wolf. So I give them a lot of credit in the tools that they have are very limited. I would argue that, getting them to full employment, that's not really a Federal Reserve job. That's a government job that they pawned off on the Fed, just like they tried to pawn off environmental, what are the
sustainable governance.
They're trying to pawn off climate change onto the Fed. Well, the Fed's going to help us. No, that's the government's job, not the Fed's job. So I think they take a little too much of the burden. But I think at the end of the day, if people understand how this works, it'll help them significantly. Because I think that's the biggest challenge: is people are going to be surprised by the outcome because they're just not. And this is where agile thinking comes in. You and I, I think we generally agree on a lot of things. We may disagree on some, but I think what the important point is just to be agile enough to your thinking to know that you could be wrong. And I try to do this every day. It's hard.
Yeah.
It's hard work. I have to challenge myself. Where am I wrong? How am I going to know if I'm wrong? I mean, those are questions I ask myself all the time. And this kind of, thought process I've shared with everybody today about inflation has been a lot of this. Where am I wrong? How do I know if I'm wrong? And so that when things change, immediately I have a plan of action. I can say, great, interest rates, we've battled inflation, we've won. How am I going to know when that happens? Because then you want to be in things like technology and bonds because they'll do extremely well. Right now you don't because they're going the other way. And I think that's the kind of thinking that everybody should have in whether it's their investments or their life is, because we all have opinions, right? Right or wrong, we have opinions. And I don't say anybody has all the right opinions, but there are opinions. And we have to look at it from a mindfulness perspective of, okay, I know that I don't have all the answers. My perspective is mine. This other person doesn't share it. But, is their perspective better than mine, right? Like, what's the lens in the world I can look at that's going to be better than the one I have today?
That's an excellent point. And for people in your role and mine, that is an imperative. You have to be self-reflective. You have to be open-minded, right? You have to be looking for areas where you're wrong, because if you don't and just tunnel vision forward, it just leads to disaster long term.
Yeah.
I mean, that's a good life lesson anyway, aside from that. That's a good note for us to end on, Kirk. This has been really great. I appreciate you taking the time and bearing with my technical deficiencies over here. You have a show of your own. You have a firm of your own for people who want to hear more of your stuff. Where should we send them?
Yeah, so you can find me a few different places if you want to find more about me. So I have a podcast called Money Tree Investing Podcast. We have a show every week. We talk about inflation there. We've been doing that a lot lately. And I also have a company, Innovative Advisor Group. Probably the best thing if people want to learn more about inflation is go to moneytreepodcast.com. And if you go to moneytreepodcast.com / inflation and then the number 2, we'll have a download for you that will give you more details on how you can learn more about inflation.
Right on. Well, thank you, sir. I appreciate your time. This has been a great discussion, and hope to have you on again sometime soon.
Yeah, I hope to come on again. This is a lot of fun, and let me know what we can do to help.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.